Zero down. That's right. Zero down. So you want to buy a piece of real estate, zero down, right? Let me teach you how. Really quick, this is one way that can be easily be done. It takes homework, it takes research, right? At its core, but it can be done. So are you ready, right? Because I'm going to explain it so fast because I know it's so fast. And that's how fast you need to learn it. So, and always know it. And so what? Ingrain it into your mind. So, real quick, how do you get a zero down deal for real estate? Number one, you need to study the market. Study the market. Pick a territory, a zip code, a small area that you believe in, that has future potential for growth, people are moving into, has population increasing, et cetera, et cetera. Why? Because that's how rents go up. Supply and demand basics. Number two, once you understand the market and you see things coming out every single day, you'll get, let's call it a basic price per square foot that things are selling for in that area, a house, a multifamily, et cetera, et cetera. Once you start analyzing the basic per square foot price, right? Asking price divided by square footage of the property for 3 bedrooms, 2 bedrooms, and things, you will get an average. Anytime that you look at something, you'll be able to say, okay, this is worth $300,000. This is worth $250,000 because you're studying the market, what's available, what's selling, what's not moving. When it's overpriced per square foot, then it's not selling. If it's, or you see reduced, right? So focus on the key performance indicator of price per square foot. Now, once you understand the market and you study it for a couple months, then you're ready for what? You're ready to see opportunities in the market because you know the market. We call that arbitrage. So all of a sudden, you can see something that pops up for sale, on the MLS, realtor.com, and you can say, oh my God, the average price per square foot in this area based on year built and, all that good stuff is $500 a foot. All of a sudden, something gets listed at $350 a foot or $375 a foot because someone didn't do their homework with the market. So then there's your opportunity. But the only way to recognize that opportunity is if you understand the market per square foot. If you don't understand the basics of the markets, the pricing, none of this is possible. So let's say you see something and it hits the market at a price below normal per square foot. That's your opportunity. So immediately, you need to know contracts and things like that. I like as-is contracts with 7-day due diligences and 30 to 45-day closing. Why? Because you throw that contract at them. If it's priced below the market, you may even be able to buy it at full asking price, get them to sign. You have a 7-day due diligence, do a 45-day close, and now you're in control of the property for 7 days to get the next steps of what I'm talking about. So that's what you do there. Number two, that's kind of hard, right? Because usually when that happens, you'll have multiple offers because there are multiple people studying the market and realize the arbitrage and the low price in the market that hit the market. So number two, you got to find your own deals below market. How do you do that? Cold calling, there's a million of them. The wholesalers use dial up, out of the Philippines and ask if people want to sell. I like calling for rent signs. I like looking for somewhat abandoned properties, things like that. So let's get into the nitty gritty on how it works. So if you study the market, then number two, you throw an offer when you see it below market and you got it. So let's give an example. Average price sells, in this area for a house, let's say $300,000. You're able to buy a house below market at $250,000. So that's about $50,000 below market. With that contract, hit the MLS, etc. Now you have 7 days of controlling the contract to make a real decision. That's what due diligence and inspections are. 45 days to close. Now, here's the key. There are several lenders, yes, and they're private lenders, and that's okay. Why? Because you will pay an interest rate higher than normal, but you'll normally pay interest only, which is almost similar to a low interest rate with principal and interest. And here's the key. You find a lender that's willing to do zero down, meaning there's already $50,000 worth of equity in the house or the property you're buying. You know the market's $300,000. You're paying $250, right? So do the math. 20% equity would be, you have around 18 to 17% equity. You've heard the phrase, real estate is made on the buy. The money in real estate is made on the buy. It's exactly what you did. So you convince the lender with multiple reports or showing him the market, show him Zillow reports, show him closes recent, that you've already got $50,000 in equity in it. So convince him to give you a zero down loan. That's right, zero down. You take control of this property for $250,000. Now, if you want to do it at the next level, during due diligence, right, when you go and do your inspections, try to get a credit from the seller. Try to get a 2 to 3% credit, which most lenders will allow, right, for fixing things. Say it's an electrical panel. Say, hey, I need a credit for $2,500 to do this electrical panel. Why? Because I can't get insurance on it. And what you do is the lender will allow a credit at closing. The goal is to get that credit at closing from the seller to cover all your closing costs and have enough money for the insurance, right? And the title and all those closing costs. By the way, you can finance insurance with about 10% down with the right insurance agent. So that's it. In a nutshell, you just bought a property with zero down that you've already got $40,000 to $50,000 of built-in equity. That's why you're willing to, or able to do it. And you use some of that equity as credits for closing costs. Now, what do you do with that? Infinite returns. It happens every day, folks. That's a true zero down deal. Now, you rent the house, you pay your loans, things of that nature, wait 12 months for capital gains taxes, and you have two choices. Sell the property for $300,000, right? But after closing costs and things of that nature, you may end up with $35,000 in your property. Or you go to a traditional bank at this point, make sure your credit is good, right? They require 12 months of seasoning, meaning you've already owned it for 12 months, which you have, and then go out, cash out. If you're in an up market, you may even get an appraisal at 320. But there will be banks, traditional banks at lower interest rates, that will finance, usually 80% loan to value, sometimes 90% loan to value. You can get a loan for, $280,000, pay off the original $250,000. You take $30,000 out of that deal, tax free, because it's debt, put it in your pocket. Now you have $30,000 to go out and buy more real estate. So I hope you learned something. That's a zero down deal. If you have any questions, feel free to subscribe, reach out for insurance audits, and smash up the likes and share this video so this will grow, will help everybody buy real estate with zero down, and many more other ways to come. Stay tuned, subscribe.